Hey everyone, welcome back to the Jack Chapple Show, and today I'm going to be talking about how to pay no taxes through real estate, and I mean zero. And if you build up a big enough portfolio, you can be making hundreds of thousands of dollars and not pay any tax on it. And this is an actual thing that happens. So I was listening to Robert Kiyosaki, the guy who owns the $1 billion of real estate or whatever, and I was surprised when he said, I might make millions of dollars per year, but I don't pay tax, ever. Even if I sell a property, I don't pay tax. Now, I just want to say this before I go into all the real reasons why you don't pay tax. He can sell a property. If you sell a property and then buy a property right away, then you don't have to pay tax on the land transfer fee or whatever. It goes under this weird rule in the United States. I don't know what it is in Canada. But anyways, so I'm going to write out an example here, and I am going to go through why you will have a net tax deduction of thousands of dollars after everything. And we're just going to get into this here. So let's just say you buy a property for you get a mortgage for $350K, $350,000 on a property, okay? That's the mortgage. Sorry, I have this written out here on my phone, so I can just keep going here. So we're going to say that based on whatever, 2-point-something% interest rate, I think 2 or 3% or something like that. I forget what I used for my example here. The interest on that loan is $8.5K per year. So this is common. You get to write off the interest on your mortgage payment every single year. So automatically on a $350,000 mortgage, you get to write off $8.5K a year. So you get from your income, if you make 50 grand, 8.5 is just knocked right off. Okay, so they assume that you make whatever that number is, 41,500. Pretty good. Okay, so moving along here. The next thing here, which is the most important thing when building a real estate portfolio, is there is a 4%, in Canada it's called a CCA, a capital cost, capital cost allowance or capital cost allowance, I think is what it's called. And in the United States, it's called depreciation. And I know a lot of you are saying yeah, I know what depreciation is. It's the value of the properties goes down, right? But in real estate, what happens is the government, says the value of the property goes down, but the price of the property actually goes up. It appreciates. And I'll explain, I'll just explain why they think that. So you're allowed a 4% write-off for the value of whatever you purchased it for. So for this example, we're going to say that it's only for the building, by the way. It's not for the land, but the building is usually the most valuable part of a property anyway, so by a lot. So for this, depreciation would account for $14,000 a year in write-offs, in tax deductibles. So why would the government allow this? So just by these two things, that's $22,500 in tax write-offs for this person purchasing a $350,000 property. So why? Keep in mind this is for an investment property. So the government has this thing called recapture. So for example, if you were to do this $350,000 mortgage, whatever you purchased it for, you take a 4% depreciation per year, and you end up writing off over the course of 3 years $42,000. So of this $350,000, you're saying that the property went down in value to $308,000. What they say is that when you sell it, you have to pay back with a normal tax amount the $42,000. So that ends up being taxed. But anything that you sell above $350,000, so if you sell the place for $400,000, the additional 50 grand is taxed in the normal capital gains way. So it's half the price of what it normally is. Anyways. So I'm going to keep going here. So you have $22,000 in write-offs just from this one property, from $350,000. We're going to keep going here. The rental income from this property, I just said, average, we're just going to say 28 grand, okay? If it's an investment property, you can get 28 grand for a 350 grand property. It's possible. All right, so yeah, your rental income is $28,000 a year. Your mortgage, total everything, is $19,000. This is including the principal and the interest. That's your total payment per year. And you're going to have $2,000 in expenses, repairing the place, all that kind of stuff. So after everything, your net income on this property would be about, $20,000, $7,000 a year. Okay, that's your net income on this property. Remember our tax breaks? So your net income is $7,000, but you have tax breaks of what? $24,000. So tax equals $24,000. So think about that for a second. This one property, if you do everything correctly, is essentially a $17,000 tax break. Now, actually, I shouldn't say that it's completely like that because you can't write off the principal of the mortgage. So this would be more like, it'd be more like $14,000, I should say. So I think the principal on this property would be somewhere around $10,000, $10,500. So at the end of the day, just by buying this property, after everything, you're going to make $7,000 and you're going to be able to write off $14,000. Isn't that weird how that works? So when you scale this up, like Robert Kiyosaki, to the point where all you're doing is investing in real estate and that's your only job, that's how you don't pay taxes and still make money. So it's because of this, the giant thing of depreciation here. So I think I have one more thing in my notes here. Yeah, no, I don't. So this is why I'm going to get into real estate investing in this next year a little more. I mean, I've already kind of dipped my toe in it a little bit last year, but I think that next year, especially because I do believe that a correction is coming in real estate, at least in Canada, has to be coming. So this is, it's something to think about here. Would you guys want to invest in real estate? Is that something, I know a lot of you have emailed me and a lot of you want to invest in real estate or are thinking about it. And this is a good way to seriously, like, if you can build up I don't know what the math on this would be, but if you could build up a $10 million portfolio, I'm guessing you could have a a six-figure income and not have to pay taxes on it. Now, here's the other thing I just want to mention is that, yes, this is just a very generic example. There's going to be more expenses. Sometimes it's going to be less expensive sometimes. The depreciation does go down in value over time. So the 4% that it would go down from a $350,000 value, that actually the next year it would be like $13,800 to write off. And then the next year would be $13,500 to write off. And then the next year would be $13,000 or whatever. It just keeps going down over the course of, I think that they plan it to be like 27 years or something like that. And by that time though, this property is going to be paid off. You could sell it or you just take out more debt on other properties. There's a way for you to not have to pay taxes while you live, pretty much. So anyways, I think that's going to wrap this video up. I'd like to thank you very much for watching. Remember to subscribe, like this video. It helps me out a lot if you do like this video. But anyways, yeah, I'll see you guys next time.